reports.
Thank you very much, Haley, and thank you for inviting me to moderate this panel this morning. I've been up on the stage a few times now, and I particularly like our backdrop today. Nice bit of colour, beautiful trees. I have requested in the past some biodiversity. Warren assures me there are some bees in here, so very happy to see that. This panel, the topic is the emergence of new investors into forestry and nature. I think it's a super topical subject. In our pre-discussion with the panel, who I'll introduce in a second, we've had some good conversations. We're going to talk this morning about catalyzing new investors, what more can be done to bring more in, how they may view risk and return questions in this area, demand and supply, are the projects available for new investors to invest in? Carbon is becoming an increasingly mainstream topic now, as we've heard this morning from various speakers. Everyone's got their own perspective on this, the corporates, the financial investors, the pension funds, etc. Look at that a little bit. Underlying project complexity as carbon goes up the agenda also becomes more interesting, and so we'll unpack that a little bit with the panel as well. And we'll talk a bit about the role of technology and how to overcome data silos to ensure sort of transferability of solutions across the different parts of the natural capital sector. My name is Martin Paulsen. I run a small advisory business called Acacia. I work with fund managers and SMEs, walking them through that process from concept to raising funds. I live close to the French Alps in the smaller hills. I every day see the effects of climate change around me. And so that's one of the reasons the stations, the ski stations where I live, have more or less sort of shut down in terms of how they used to operate. So I see it every day. It's a lovely place to live nonetheless. But this bringing in new capital into this sector, getting more capital into these sorts of projects in a responsible way is part of the solution. We need new investors. We need them to be taken seriously and being competent as regards impact and sustainability. We need new thinking as to how to invest and how to make things profitable and impactful at the same time. So I'm really happy to have an excellent panel here today. On the panel, we've got a range of different perspectives, which I think will allow us to look at this from different angles. We've got the public sector represented, we've got the advisory side represented, we've got nature-based solutions investors and VC-style investors here on the panel. So I'm looking forward to this. I'm going to ask the panel to introduce themselves briefly. I did promise before this panel to give them a bit of airtime at the start. If you can sort of keep it reasonably brief, lady and gentlemen, that would be great. But I'm going to start at the far end. Sean, if you don't mind kicking off, and then we'll come back this way. Just introduce yourselves. And if there's one point you'd like to mention on this theme in your introduction, fantastic. Go ahead.
Yeah, Sean with Gordian Knot Strategies. We're a climate finance consultancy based in Portland, Oregon. I've been in the carbon markets for 20 years. We work with endowments and high net worth family offices, impact investors, institutionals, primarily investing in nature-based solutions in Europe, Africa, South America, and the US. We've been an advisor to the Integrity Council for the voluntary carbon market for 2 years. And I would say, to answer your question, Martin, sort of the one word which I will dive into in a bit, is the one word is mismatch. Thank you.
Great, that sets the scene nicely. Go ahead, Alice, you're next.
Hi everyone, my name is Alice. I work for Edafon, a Belgian impact fund dedicated to sustainable agriculture and to the preservation of natural capital. Edafon was founded quite recently, in 2022, with the belief that healthy soil is crucial to solving today's environmental challenges. We operate as a traditional LPGP fund and invest in companies where impact is central. As an evergreen fund, we have no fixed end date, meaning that we're able to support the extended investment horizons that are often needed in sectors such as agriculture and forestry. We invest globally in Series A to C stage companies and target innovative and scalable business models. Now, just a little bit about myself. I have a background in environmental engineering and a master's degree in machine learning applied to environmental issues. At Edafon, I get to combine my interest for the environment and for technology to drive positive impact. I'm very happy to be here today and excited to see where this discussion will lead us.
Great, thank you, Alice. Martin, you're next.
Yeah, thank you very much, and thanks for having me on today. My name is Martin Halley. I work for UNEP, the UN Environment Programme, within its Climate Finance Unit. Our remit is really to try and increase the amount of private capital going to this sector. As part of that, I also manage, together with colleagues from the Frankfurt School, the Restoration Seed Capital Facility. And that's really looking at the impact side of things in forestry and sustainable land use, and trying to support emerging fund managers in this space to set up more vehicles in this area and to fill in their pipelines. And really that gives us, I think, quite a good view on the current state of the market, at least from that perspective. And we certainly have seen quite a shift, specifically at least on the forestry side of things, in the investor base for this kind of fund. So I'm delighted to be on the panel today and to be able to discuss this. Thanks.
Great, thank you. Sam, last but not least.
Hi everybody, my name is Sam Lampert. I'm an investment director with Morova as part of our natural capital team. For those who don't know, Morova is an asset manager focused around sustainable investing and fully dedicated to the ecological transition. We have about 30 billion euros under management across a number of different strategies, ranging from listed assets and public equities through fixed income strategies, all the way through private assets, including energy transition and natural capital, where I work. Specifically within natural capital, we think about kind of three big main areas that are high priorities. So the first is around sustainable ocean management and thinking around marine ecosystems and shore to figure out how we can help make sure that there is less plastics in the ocean and that communities can live and thrive around marine-based ecosystems. Second, we think around sustainable value chains, very much looking around agroforestry, thinking about how we can work with both investors and corporates to provide a sustainable supply of low carbon intensity commodities across both food and fiber. And then finally, where I focus and I spend most of my time is in our environmental assets team. The environmental assets team is focused on nature protection and restoration, investing in projects that are primarily driving revenues from the voluntary carbon market, both across reducing drivers of deforestation, helping afforestation, reforestation, and revitalization, as well as blue carbon, such as mangroves type projects, soil, as well as regenerative agriculture. So it's a pretty broad remit within the nature space. Lovely to meet you all.
Thank you, everybody. Right, so let's get the ball rolling then. I'm going to start with you, Sean, here. And mobilizing capital has been a central theme to my working life for a good number of years now. You gave us a teaser there, Sean. You said you used the word mismatch. I'd like you just to talk a little bit about your views on how to get more capital to flow, what you see potentially as issues in between the sources of capital and the users of capital. So yeah, perhaps your top three things that could be really dealt with or improved to improve that all-important source of capital flow into these projects.
Yeah, I mean, I'm going to point out the problem, and I don't necessarily have the solution. I'm just going to share with you the daily, weekly, monthly deluge of calls that we get from around the world with people who have, I'll use the word miraculously because I'm impressed, they assemble $750, $500 million, $2 billion, and then they call us and they say, we need help trying to figure out how to invest this capital. So tons of money, tons of interest, but a complete mismatch on risk tolerance, tenor, returns. And then on the flip side, we also get calls from people who are on the ground, who are deploying the interventions in Africa, South America, and wherever, and they're looking for capital to advance their projects. They don't understand the world of impact investing. They're trying to translate that. And there is this awkward discussion between the project developer and the financing source where it becomes abundantly clear, frustratingly, after 2 to 3 to 4 to 5 to 6 weeks, that the mismatch can't be overcome. I would say predominantly it is because of the tolerance for risk. We all know nature-based solutions take a while to accrue their benefits. Edifund's an interesting outfit because they're evergreen. There's not a lot of evergreen funds out there. And so they've got an investment horizon that just doesn't fit with NCS, basically. So that's a real problem. The other is these funds come to us and they say, we want to deploy capital. Here's our screening process. Here's our due diligence process. What do you think? And it's awful. It may well work for mainstream investing, but it does not understand and frame up the investment opportunities on the NCS side. So that's screening and due diligence is a very big mismatch. And then the third thing I'll talk about is we've all seen the banner headlines. They are eye-catching, I guess, in the sense that there's some sort of catalytic launch of capital backed by a syndication of philanthropies and the like. And the challenge is that they still treat the investments behind those as snowflakes. They are not talking about a systems type of change. And what I mean by that is the ability to mobilize those philanthropic capital sources to deliver credit enhancement or credit risk reduction. Because all of you who are deploying capital are confronted with a risk profile that's not that great, or the returns are not that great, or the tenor's not that great, and you want an exit. And that's where catalytic philanthropy should play a role, is in the credit enhancement or de-risking. So those are my top three. Thanks, Martin.
Great, no, thank you. It's a recurring theme in funds that I'm working with as well, trying to find ways to introduce a junior layer of risk to try and get those who are thinking about it over the line and to actually commit. I'm sure we'll come back to that theme as well. Let me come now to you, Martin. We've got more capital which is looking at this sector, which is potentially available. Could you share a few thoughts from your perspective on how to make sure that those new entrant investors, and we hope there'll be many of them, particularly private sector investors who come with a range of perspectives, how do we set in place the kind of conditions and the criteria, the regulations, to enable them to do so in large volume, but also in a way which is, let's say, positive from an impact perspective?
I think that's a real challenge. I mean, I would definitely agree with Sean's point. I think there is a mismatch between, the many financial institutions that are entering this space and say, we have all this money to deploy there, but they generally are poorly acquainted with the realities of nature investing, and some of them can be improved, but in many cases it's down to the fundamentals of what is a nature investment, and these are in general complex. They're fairly idiosyncratic, and they're in many cases relatively hard to scale. And so these are really aspects of nature investing that won't change, and with which these investors, if they're genuine in their desire to engage with the nature investment space, have to at some point come to terms with. And maybe the use of blended finance is one way to do that, but part of it is also, I think, an important part in investor education. I'd bring it back also to the comments that Chris Knowles made in his introductory part this morning, which is, ultimately, I think we are at a stage right now where we're seeing some goodwill and some movement of capital and some interesting sort of green shoots out there, people trying, but it's still relatively small scale, and I don't think that will change until there's a real movement on the regulatory side. I think until there's a real push that either changes the nature of demand or changes production conditions on the ground through regulation or through facilitation, as we also heard, through making it easier to do things in the right way. I think it's difficult to just purely rely on the goodwill, and I don't think scaling will come just through that.
Okay, great. So a combination of regulation, education, and I suppose also setting up projects in a way which hard codes those good aspects into them can help. Let's come now to the practitioner, the investor side, with you, Sam. And I think what I see in my working life, at least, is carbon is now becoming quite a mainstream aspect of many projects that I'm looking at. Investors are paying more and more attention to those revenues than they used to, which might have been considered in the past to be kind of a nice to have or a cherry on the cake. So it's becoming a more solid part of a project. That increases the complexity to some extent, I suppose. It'd be great if you could just talk to us a little bit about how you think about value in forestry and other nature-based solution investments, and how is carbon becoming a part of that vision of value in the eyes of investors?
So, thank you. So I want to agree strongly with both Martin and Sean But then also I want to try to offer a little bit more of an optimistic take on some of these challenges that we see. And I think it has absolutely everything to do with value. What we're seeing in the market today is the emergence of carbon as a way of pricing and valuing the ecosystem service of carbon sequestration that forests provide. And that allows project developers to create a layered approach that combines an additional source of revenue across existing activities. It also allows areas that had no source of revenue, so RED Plus projects, for instance, to start having a new source of revenues through carbon markets that really allow kind of a very interesting space. This is a movement in the right direction. It is certainly not sufficient. A year ago, we were able to say that it was a $2 billion market. Now it has gone down significantly, looking at kind of recent developments. But there is positive movement in the space all the same. If you look at the statement from the US government, with Secretary Yellen's statement endorsing principles and guidelines for the voluntary carbon market, you look at some of the large commitments by different companies around it, that you do see kind of positive movement in the space. You also see in the EU increased regulation around the carbon and carbon removal. And I think those are all very, very positive developments moving in the way that Martin laid out of kind of seeing regulation increasing demand. The other thing that we're seeing in this space is increased specialization around it. And that helps very much to what Sean was mentioning around how do you address this mismatch of kind of having fund developers who don't have the necessary expertise to invest in nature. And that as you see more capital coming into the space, you'll see more expertise coming to the space, and you'll start to see models that are able to allow kind of large-scale investment in a much more aggressive way.
Okay, no, excellent. So the capacity is growing, sophistication is growing in the situations you see. And I will just say to the panel, if any of you wants to come in on points I'm asking one of the panelists, feel free just to raise your hand or something. I'm going to come to Alice now and change gear a bit, but I'm then, after Alice's question, going to just, to keep the audience or get the audience involved here, ask you if you've got questions halfway through. There'll be a chance at the end as well, but if anybody's got questions already now, happy to take one or two. Alice, you are more on the venture capital side here. You're investing in this broader theme, as you said in your introduction. I'm interested if you could just talk to us a little bit about conditions or context that will allow investors like Edafon to put more capital to work in this space, to be more confident in putting capital to work. And how can the sort of VC industry, the tech-oriented, in some cases, I know that's not all you do, but in some cases the tech-oriented investors, how can we bring them in and have them play the maximum role here to encourage these developments?
That's a great question. So right now about 2 to 4% of total climate finance is dedicated to agriculture and forestry. And VC investors often hesitate to invest in this space because of the, as Sean just mentioned, the extended investment horizons that are needed. I think that the natural cycles of biological growth and ecosystem processes contribute to this. But I believe that technology and innovation can bridge this gap. For instance, we just invested in a company called Meridia, which leverages technology to ensure that data collected from smallholder farmers in cocoa and coffee is accurate and reliable. And this not only helps companies meet the EU deforestation regulation requirements, but also ensures faster identification and mitigation of deforestation and empowers smallholder farmers to access regulated markets. Another example is Aurora Tech, which is a company that uses satellite imagery to detect and monitor wildfires globally. And this helps governments and firefighting agencies to protect people, nature, and biodiversity. And so I feel very inspired to see that innovations such as these can make a tangible difference while hopefully also generating quicker returns and involving risks, but risks that VCs are already accustomed to handling. And so to answer your question a bit more directly, I think that this space can be much more appealing for VC investors if we recognize that there is a missed opportunity in the lack of climate finance dedicated to agriculture and forestry, and that technology can bridge the gap between long-term impacts and shorter-term returns. And yeah, I hope, I think that this will allow more capital to flow into nature-oriented investments.
And it sounds like you see the way in there quite well at this stage. So it's not as if you're excluded anywhere. You feel access is available.
Yeah.
Yeah. Okay. Great.
Can I make one quick comment?
Yes, go on, Sean. Yeah.
On Samuel's point? So I agree there's a positive lens, 100%. I think Christopher's comments this morning were very potent and relevant, because the renewable energy business obviously has scaled, and it has followed what the Deutsche Bank framework released in 2009, which is TLC, which is transparency, longevity, and certainty. And in the carbon market space or the natural capital investment space, we do not have TLC. We have fragmentation, we have uncertainty. And the minute we can start, not the minute, as we continue to build the TLC framework, I think we will continue to see these positive gains. I just want to put a positive spin also. Thanks.
Okay, great, thank you. Let's do two questions from the audience now. There's a hand up here. Is there a mic we can just quickly give to this person here, and then a second question? Anybody? A second one here. Okay, let's do two quick questions, and then we'll come back to. I've got 4 more questions for the panel before we come to the final Q&A. And just say who you are, please.
Sure. Thank you. Christoph from Woodland Savers. We are a nature recovery project developer rooted in community equity in the UK at the moment. So a year ago, the Paulson Institute estimated the biodiversity finance gap at 700 billion and losses without that finance by 2030 at 2.3 trillion. My question to the panel is, what are the instruments that we need? What are the finance products that we need to unlock that capital? And what are the obstacles to the development of those instruments? Is it just regulation, or is there something else?
Great, thank you. Let's take the second question immediately, and then the panel can answer both questions at the same time. Can you get through there, Hilly? Not easy. Just say who you are as well, please.
Hi, good morning. Maurice Ryan from Greenbelt Forestry in Ireland. It's a question probably to the panel, and probably backs up the previous question. It's in relation to when people are looking to invest, and Sean, you looked at this from a mismatch. Is it just an immediate return on investment they're looking at, or are investors now looking at the longer term potential benefits that might be garnered from this, such as access to potential for green finance? And is there a way to build that into both sides of the equation, that the landowner or the small project developer gets some intrinsic benefits, but the investor gets downstream benefits? So it may not be an immediate bottom line, but a further downstream bottom line return.
Okay, to the stakeholders around the project, you mean?
Well, that you can access. So, for example, we're developing projects in Ireland around biodiversity value where there's absolutely zero commercial return to the companies who are developing the project in immediate terms, but they can utilise that in terms of their compliance reporting projects, and utilise that then as an opportunity to potentially get access to green finance, which is, if you're a developer, a commercial real estate developer, for example, 0.75% off a 500 million loan is significant. So that's where their return comes potentially. Okay,
thank you. Over to the panel. Anybody like to make comments on one or both of those questions? Sean, you can.
Yeah, I'll go first. I mean, so again, this is my perspective at Gordian Knot Strategies. We talk about an impact capital sandwich. The first layer of capital is to fund demonstration or validation projects. You need that on the ground. The second is you need to be able to provide some sort of de-risking mechanism. Then you've got debt, preferably patient debt, and then you've got equity. The condiments are supporting policy, administer appropriately. And so when we look at the debt piece, which we are very bullish about, the one opportunity or the instrument that we believe unlocks a tremendous amount of potential is the labeled green bond market. Why? because the appetite for green bonds exists. The market demand can take $500 billion between now and 2050 and still not exhaust demand. Green bond capital is patient, has a low coupon, and is specifically designed for the types of work that many of us are involved in. So to me, that's the instrument. The challenge with it is you need credit enhancement or credit guarantees such that the bond investor knows that they're covered from any type of default. Where do we get that from? Governments are not stepping in. Internationally, we have USAID, or the newly formed version of it. But in the US, for example, there is no entity that steps in with that kind of credit guarantee. That's why I talk about philanthropic capital. To me, investing in an individual project as a philanthropy is great, I guess, but not as powerful as creating a leveraged effect by using their off-balance sheet capital to back the guarantee of a series of bonds to deploy into nature-based solutions. So that's my response. Thank you.
Great. Anyone else like to pick up?
Maybe just to first bounce off that and then go back to the first question, but I fully agree with that, and I think that the use of that kind of credit enhancement instrument is underused at the moment. At UNEP, we also support a fund called the Agri3 Fund. They're based precisely on that model of trying to provide guarantees to banks to try and entice them to provide capital that loans to farmers essentially to finance their agricultural transformation towards more sustainable land use. And that's proven really useful. However, I think what they've seen is it's often not enough.
Yeah.
So the credit enhancement is one piece, but often it really comes with this bringing of knowledge and expertise. You need to get the financial institutions to a point where they get comfortable with the ideas that are there, with the realities of land use, of what the agricultural transformation in this instance means. And so it's really that relationship building. So it's longer, it takes more time. It's not as simple as just having a financial solution, but it's certainly extremely important. And I agree with you, potentially a very potent instrument. Maybe just to come back to the first question on that biodiversity gap. I fully agree, and I think today it's been quite noticeable that a lot of the conversation around nature markets has focused on carbon. But there is, as I'm sure you all know, quite a bit of excitement as well around the potential to monetize other environmental benefits and biodiversity particularly. Now, we've all seen how complex and difficult things have been on the carbon markets. Biodiversity is yet another order of magnitude in terms of complexity in certain ways. But we've seen a lot of encouraging developments there. I think compared to the carbon markets, there's less of a lag, perhaps, between advancements in the market and a growing sense of integrity and standardization. So those efforts to try and shape the market better are already well afoot, and we're starting to see, I think, beyond just talk about it, the first transactions where really the potential for biodiversity credits is playing a part, and the first investors putting money into projects with a view to eventually making use of that kind of instrument. So I think there's hope there, even though I'd be quite cautious as well in terms of the need to make sure that market develops with integrity.
Okay.
Anybody have an optimistic take?
Yes, I started optimistic. I might kind of on concrete. I think maybe to kind of build on the previous points. The way we're going to scale is by using instruments that people are comfortable with, and that is going to be a key piece of it. So it's finding examples like green bonds that people can price, that they can understand, and that they can kind of fit within their existing risk models. And I think that is a major question. And so when we talk about kind of either blended finance or financial innovation in this space, it's really around kind of how do you take existing tools, proven tools, and allow them to be adapted so that they can provide a risk return that allows to channel a lot of capital. I think until that is the fundamental question to solve. If I'm going to put my optimistic hat on, I think it's going to require demand drivers such regulations, investments in technology that allows us to drop down cost. And if those two things happen, yes, we can achieve it without any problems. We have the capital available, but it requires, I guess, Sean's condiments to make all this work.
Okay, good. Let's come back to the panel Q&A or the panel questions after that. Thank you for those audience questions. There will be an opportunity in 10 minutes for more. Sean, there's some specifics that have been discussed here, how to get capital to flow using existing frameworks, or how to improve existing frameworks. Any thoughts, maybe slightly more kind of free-thinking thoughts as to basic things that could be changed in the way investors think about what success is and what success isn't? Any slightly more radical ideas that you think should be thought about, discussed, as to and as a way of making sure that really the very large sums of capital you're talking about, that they actually do start to flow? And are we too stuck in sort of current reference mindsets? Any thoughts on that?
Well, I'm going to come back to the carbon markets just because, and I'm a huge fan of ecosystem services and biodiversity. I just think, again, my jaded hat, everything that we've gone through 20 years of carbon, we're going to see the same thing with biodiversity once it starts emerging. People are going to talk about additionality, permanence, integrity, and so on. Not that we shouldn't go there. So I think we need to be prepared, and I agree with you that we'll get there quicker. But specifically on the carbon markets, I think the emergence of the core carbon principle label for issued carbon credits is an extremely important piece, because the core carbon principles encompass a number of co-benefits above and beyond just the carbon quantification or mitigation that's occurred. And coming back to your point, Mr. Ireland, that the challenge we've seen, and we procure between 15 and 18 million credits a year on behalf of some of our clients, is they all want co-benefits. They want them rich, they want them diverse, they want them in bucket loads, but they will not pay an additional cent. And so for the first time, with the emergence of CCPs, we're going to see that premium, and people are already talking about a 15 to 20% premium on them, which will move the market. Moreover, it will bring a sense of confidence to buyers. In the same way they buy an organic apple, they can now buy a CCP credit and feel comfortable that there's assurance. So I think that's a really important thing. The other more controversial point is that typically we've seen corporations use credits in a way that shows them doing good. And I'm all for that. I think that making sure they address their scopes and then the hard to abate residual emissions using high integrity credits, first class. But I do think that the value proposition of carbon credits is problematic, because if we, for example, controversially changed it, and we actually said that the use of carbon credits is really a litmus of how much work companies have to still do, as opposed to what they're doing good. It's a contradiction, because as Chris said earlier, those people that are doing great stuff are hushing it, and people that are doing nothing get away with doing nothing. So there's this like weird situation going on. And so overall, when we look at the carbon market and we issue all these opinion pieces on the carbon market, the value proposition is not great. And that's why I agree that there's a certain amount of regulation that needs to come in. I love market mechanisms, but we need the condiments. And I think that's the part that will bring this market to maturity. Thank you.
Great. Thank you. That's great. And so, I mean, behind all that, there is inevitably, an element of additional complexity coming into these discussions. Martin, I want to come to you on this one now. Is there a problem connected to that complexity, and how can it be solved? I mean, is that complexity in itself, even though it represents in some ways a maturing of the situation and additional sources of revenue which are really meaningful, can that also in itself become a brake somehow to investors coming in?
Yes, I think there is a bit of a tension there. I think, if you look particularly, for example, at the forestry sector, where typically, as we've heard this morning, in terms of what drives the fundamentals of investment in forestry, it's largely been seen as a sort of, in terms of an asset class characteristics, right? So quite undifferentiated. You're investing not in a specific piece of timberland, but you're investing in, forest as an asset. And I think with the emergence of more impact-minded and the carbon angle particularly, then you're bringing in these additional values and additional attributes to forest projects that are, very complex and are in many ways quite different also on the ground in terms of the operations. So for the managers of these assets, it's also, in a sense, a different job from just managing a productive forestry asset to turning it into, a multi-revenue, multi-activity type of asset that's going to create not only that stable income from the forestry side, but also those co-benefits in terms of carbon, biodiversity, maybe community relations and livelihoods, whatever it might be. So I think that's overwhelmingly positive because it is turning what is quite a large investment pool that is looking at these kind of assets and leveraging it for better impact. But it does come with complexities and a bit of tension at times. So yeah, I think there's a tension there.
Good. I've got a question for Sam there, then Alice, and then we'll come to the audience. Sam, I mean, sort of connecting a little bit to that. One of the, in a sense, antidotes, or one of the ways to get markets to continue to build their support for certain types of investments is examples of success, projects that have done really well. Maybe you can give us a sense of, from Mirova's perspective, what are the things that you can do in addition to investing, if you like, to try to make sure that there are as many case studies, examples of great success in the sorts of projects that we're looking to get capital to go towards here?
Well, first of all, let me plug the impact reports that are on the Mirova website, which have this case studies exactly across our funds and the things that are looking at kind of what we think of as success. I think what's tricky in the impact investing space is that there really are two definitions of success. There's obviously, did your fund generate a financial return that is alongside the expectations of its investors? Yes or no, and that's a very important metric for success, and probably when we're talking about scaling capital to the amount that we need, is probably the most important dimension of success. Obviously, there's also the question of success, which is around the impact that you have. And here, one of the things that's been one of the things that's important to keep in mind is that when you're looking at carbon markets, it is by far and away the most rigorous way of measuring impact across any of the other impact investing spaces. The level of transparency that is required in terms of putting your project description document on a public registry, making sure there's public comments on your kind of how this project works, being very, very clear around how the project is financed and who is retiring the credits, is a level of transparency and rigor that you see nowhere else in the impact investing space. Furthermore, it is getting both more rigorous over time, I think we've all seen that with new methodologies, and actually simpler over time. When you think about it, we talk about a ton of carbon, but actually what we mean is a ton of carbon equivalents that groups together a number of different greenhouse gases, which is already a huge simplification. Very, very soon we'll be just talking about CCP credits, which again simplifies all these ideas around kind of what is a ton of carbon removed or avoided, alongside all the other co-benefits that you're able to see. So we are making progress as a market and as an industry around how do you think through this way that captures both the financial returns for it, as well as allowing us to simplify it to enable more investment coming in.
Great, thank you. Alice, shifting gear a little bit now to the VC perspective again, one of the things which would clearly allow your community to invest more in these sectors is to deal with what in some cases is problematic in terms of data regarding these sorts of projects sitting in silos. There's a tremendous diversity of investment types, from forestry to other sorts of natural capital investments. How can that be fixed? How can that be improved to, in a sense, improve or build the scale of your opportunity even further?
Yeah, so from my perspective, I think that addressing data silos is crucial for maximizing the impact that AI can have in our sector. As you just said, many companies in our field keep their data proprietary, viewing it as a competitive edge. And but this really limits the development of robust AI models that need large amount of data from various sources to effectively predict forest growth, crop yields, carbon storage. And to add to that, unlike other fields such as, for example, computational biology, we don't have controlled environments. Instead, we deal with complex biological systems that are influenced by a multitude of factors, weather, location, soil condition, agricultural practice, etc. And this makes our data less standardized and much harder to collect and manage, which again I think highlights why it's so essential in our field to have access to a wide range of data from various stakeholders and sources. Thankfully, maybe I'm a little bit hopeful, but thankfully I think that upcoming and new regulations such as the Corporate Sustainability Reporting Directive in Europe or the European Deforestation Regulation could help change this by encouraging everyone to work together, from farmers to retailers, and considering the entire supply chain. These regulations promote transparency and standardization of data, and I'm hopeful that this will allow, this will help us get access to more data and unlock the full potential that AI and technology can have in agriculture and forestry.
Great, thank you.
Just on that and kind of the importance of data and data being coherent, I'm going to steal a point from the biodiversity consultancy that I heard at the CPIC semi-annual meeting a few days ago, which I know a couple of people in the room were here. Talking about biodiversity credits and the demand for biodiversity credits, today we have a problem, which is that TNFD, so the reporting requirements on nature impacts and dependencies, uses a different unit of analysis than most of all the other units of analysis that we're talking about with biodiversity credits. And so if we believe that you have TNFD as a potential driver for corporate action around biodiversity, they're going to have a problem of kind of being able to match up, okay, this is our impact and our dependencies, and this is the activity that we're doing on biodiversity credits, and there's some sort of coherence between the two. So it's a good example of kind of as solving some of these fundamental data problems is essential, as Alice points out, for kind of allowing better AI and allowing better understanding of the kind of impacts, but it's also just fundamental for driving demand and driving more capital into the space.
Good, okay. Well, we've already warmed up the panel with a couple of audience questions earlier. I can see lots of hands about to go up. Let's take 3 questions just to get through as many as possible. Chris, you spoke, so maybe you could take one. Tony, you've asked one already, I think. Maybe I should give it priority over there. There's a gentleman here and a gentleman in red here. Could you just take 3 questions quickly, and then we'll come back to the other ones if we've got time, of course.
Yeah, thanks, Martin. Bit of a challenge for Sean, and I say this because I think I agree with pretty much everything he said this morning, and I hope he'll have a chance to explore that a bit further after this. But on the green bonds, my experience, bond markets need a balance sheet. A bond issuer needs a balance sheet, and it works well for regular borrowers. It's not a natural fit for a one-off issuer, maybe a twice-off issuer, probably a small issuer, and probably without much of a balance sheet. It's very expensive, and probably, you probably only get away with a private placement, some kind of loan substitute. So is it really a panacea? I'm not sure. And perhaps also to take a note, it does not come with the greenium. Martin and I both worked with EIB for a few years, and one of the biggest green bond issuers in the world. The outperformance took about 10 years to come. It was about less than 5 bips, 10 bips, and in the secondary market. EIB as an issuer hardly saw any of the action, and wasn't much to see in the first place. Bit of an invitation, and I will be quick. We've had a lot of discussion about risk underwriting, need for a mechanism to de-risk some of these credit possibilities. I've recently been approached by somebody who wants to set up a platform to do exactly this, precisely because the governments aren't doing it, because the philanthropic stuff isn't really there. If anybody would be interested in contributing, working, come and grab me afterwards, and I could perhaps put you in contact, because I've been asked to give some advice, but I think this needs a bigger audience than I can provide.
Great, thanks, Chris. I'm getting a time signal at the back here, but if there's a mic over here, that would be great. Yeah.
How you doing? Enda Keane is my name. I'm a forester from a company called Tree Metrics. My question is, maybe to Sean, is where the hell are the governments in all of this? Maybe that's a simple question, but I'm baffled because I've been stuck in the forest, to use Peter's term there earlier, for the last 20, 30 years. I'm not high finance literate, but the big elephant in the room for me is that the government needs to step in here and get on with it.
Okay, thank you. And there was a gentleman in red here, I think, who had a question. It's coming. No, go ahead, shoot.
Okay, well, thank you, Harry from Rabobank. We've heard a lot today in a few of the different talks, and especially in this talk about the co-benefits and sort of maximising the value from the projects by selling those. But everyone's, understandably why, is focused on carbon and biodiversity. But water is, of course, the canary in the coal mine and the driver for a lot of deforestation, pollution, and the natural resource you need for any of these projects to actually work in the soil. So have you been seeing much interest in water coming into the investment horizon? And maybe for Alice, in those early stage companies, is there more focus on water now?
Thank you. Feel free to take one or more of those questions. Please be succinct. We're getting short on time, but who would like to? Alice, do you want to kick off with an answer to that question?
Yeah, actually, I haven't seen much interest in water, so I don't have much to say on that.
Okay, fine.
I'll be very quick. Governments don't make markets; they follow markets. So we saw what happened with Biden in the announcement supporting voluntary carbon market is a good example. I agree. Where are the governments? Where the hell are they? But they follow. Christopher, yeah, I agree. That's why we need the ability to create a mechanism, and I'd love to join that conversation because we've designed a turnkey bond finance mechanism. We need that facility such that the low balance sheet providers can actually participate in a meaningful way at scale. Thank you.
Gents, any comments on the questions that were put?
No, maybe just on Enda's point. I mean, I couldn't agree more. I think there's a real issue in terms of government action and regulation action. I think that the issue is just the timeframes involved, both at national government level and especially at intergovernmental level. They're just not up to the urgency of the task. And a lot of what we're looking at in terms of impact finance and all that, shouldn't really exist. It should be just finance, but properly regulated. But while we're waiting for that to happen, and we've been waiting for a long time, we're forced to look at these more sort of voluntary type of actions.
Apologies to those who put their hands up. There's no time. Thank you very much for a pretty intense and rapid fire exchange here for the panel. We should give them a round of applause, please. Thank you. And,
Nice work.
Yeah.
Thank you. Right, so we're going into the final session in about 90 seconds.